Welcome back, my friends. Has Meta become a mature technology company whose heady growth days are over? The news today is that tech's longtime high flyers are growing up by getting smaller. Meta, Alphabet, and Amazon are all growing at much slower rates than in the past, but investors are rewarding them for financial discipline. Meta shares surged 17% in pre-market trade after announcing first-ever dividend. Meta reported a tripling of profits in the fourth quarter and issued its first-ever cash dividend. Revenue rose 25% in the quarter for Meta, from $32.2 billion a year earlier, marking the fastest rate of growth for any period since mid-2021 amid a rebound in the online ad market. Investors praised Meta's decision to issue a dividend, a rare step for a high-growth technology company. These companies cut thousands of jobs last year and are indicating that headcount growth will be minimal. They continue to invest for the future and play offense, while at the same time manage expenses in this tough environment, said Daniel Flax, an analyst at Neuberger Berman. But before we get into all of that, I would like to thank everyone who views my videos. If you would like to support the channel, please see the link to Buy Me a Coffee in the video description below. And please hit the like button and leave me a comment below. I would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Technology companies are learning an old lesson from Wall Street. Maturing means shrinking. Meta and Amazon saw their shares spike on Friday following their fourth quarter earnings reports. While revenue for both topped estimates, the story for investors is that they're showing their ability to do more with less, an alluring equation for shareholders. There's also a recognition that investors value cash, in many cases, above all else. The tech industry has long preferred to reinvest excess cash back into growth, ramping up hiring and experimenting with the next big thing. But following a year of hefty layoffs and capital preservation, Meta on Thursday announced that for the first time, it will pay a quarterly dividend of 50 cents per share, while also authorizing an additional $50 billion stock repurchase plan. That comes after cash and equivalents swelled to $65.4 billion at the end of 2023, from $40.7 billion a year earlier. Meta also announced a $50 billion share buyback. Investors praised the dividend announcement. Ben Berenger, technology analyst at Quilter Cheviot, said this represented a symbolic moment and indicates what a turnaround story Meta has been on since its struggles in 2022. Mark Zuckerberg is showing that he wants to bring shareholders along with him and is highlighting that Meta is now a mature, grown-up business, Berenger said in emailed comments. Investors have also been focusing on Meta's moves in the artificial intelligence space. The company has a stake in the ground in AI with its Llama large language model, a competitor to Microsoft-backed OpenAI's GPT-4. Berenger called Meta a closet AI winner and said the company's AI, while not out in show, will be better servicing advertisers and making the ads themselves more relevant for users. Cash dividends are a rare step for technology companies, which tend to be valued by investors on their ability to achieve high growth rates that requires cash investments back into the business. Meta CEO Mark Zuckerberg declared 2023 to be the year of efficiency, and it seems to have paid off. Meta CEO Zuckerberg made a big push for 2023 to be a year of efficiency for the company. Several investors had questioned its ventures in 2022 into areas like virtual reality and the metaverse, which was an incredibly costly initiative for the company. Meta has been deep in cost-cutting mode over the last year or so in response to the changing tide of sentiment around formerly much-loved technology stocks. Those cost-cutting steps appear to have paid off. Meta reported a doubling of its operating margin to 41%. Meanwhile, the company's expenses decreased 8% year over year to $23.73 billion. That's as Meta slashed headcount dramatically, laying off 20,000 people during 2023. Sales in Meta's Reality Labs unit passed $1 billion in the fourth quarter, Meta said, though the virtual reality unit recorded $4.65 billion in losses. The key with these companies is really that they're able to reinvent themselves, said Daniel Flax, an analyst at Neuberger Berman, in an interview. They continue to invest for the future and play offense while at the same time manage expenses in this tough environment, he said. Amazon is less aggressively moving to send cash to shareholders, but the topic is certainly being discussed. The company instituted a $10 billion buyback program in 2022 and hasn't announced anything since. On Thursday's earnings call, Morgan Stanley analyst Brian Nowak asked about plans for additional capital returns. Just really excited to actually have that question, Finance Chief Brian Olsavsky said in response. No one has asked me that in 3 years. Olsavsky added that, "We do debate and discuss capital structure policies annually or more often. but said the company doesn't have anything to announce. "We're glad to have the better liquidity at the end of 2023, and we're going to try to continue to build that," he said. After years of seemingly unfettered growth, the biggest internet companies in the world are firmly into a new era. They're still out hunting for the best technical talent, particularly in areas like artificial intelligence, but headcount growth is measured. Staffing up in certain parts of the business likely means scaling back elsewhere. For example, Meta CEO Mark Zuckerberg told investors that when it comes to AI, "We're playing to win here, and I expect us to continue investing aggressively in this area in order to build the most advanced clusters." Later on the call, when asked about expanding headcount, Zuckerberg said new hiring will be relatively minimal compared to what we would have done historically, adding that, "I kind of want to keep things lean." The story is playing out across Silicon Valley. January was the busiest month for tech job cuts since March, according to the website layoffs.yi, with almost 31,000 layoffs at 118 companies. Amazon and Alphabet added to their 2023 job cuts with more layoffs last month, as did Microsoft, which eliminated 900 roles in its gaming unit shortly after closing the acquisition of Activision Blizzard. Downsizing this week hit the cloud software market, where Okta announced it was cutting about 400 jobs, or 7% of its staff, and Zoom confirmed it was eliminating less than 2% of its workforce, amounting to close to 150 positions. Zuora announced a plan to cut 8% of jobs, or almost 125 positions based on the most recent headcount figures. Evan Sohn, chairman of Recruiter.com, called it a very confusing job market. Last year, tech companies were responding to dramatically changing market conditions. Soaring inflation, rising interest rates, rotation out of risk. After an extended bull market, Meta slashed over 20,000 jobs in 2023, Amazon laid off more than 27,000 people, and Alphabet cut over 12,000 positions. The economy is in a very different place today. Growth is back at a healthy clip, inflation appears under control, and the Federal Reserve is indicating rate cuts are on the horizon this year. Unemployment held at 3.7% in January, down from 6.4% 3 years earlier, when the economy was just opening up from pandemic lockdowns. And non-farm payrolls expanded by 353,000 last month, the Labor Department's Bureau of Labor Statistics reported Friday. Tech stocks are booming, with Meta, Alphabet, and Microsoft all at or near record levels. But the downsizing in the industry continues. Companies are still in the cleanup from 23, Sohn told Worldwide Exchange this week. There could be a flipping of skills, different skills necessary to really handle the new world of 2024. In fact, recent layoffs are fueled by changing skills and push for AI. Wall Street is rewarding tech companies for improved discipline and cash distribution, but it raises the question about where they can turn for significant growth. Other than Nvidia, which had a banner 2023 due to soaring demand for its AI chips, none of the other mega-cap tech companies have been growing at their historic averages. Even Meta's better-than-expected 25% growth for the fourth quarter is a bit misleading, because the comparable number a year ago was depressed due to a slowing digital advertising market and Apple's iOS update, which made it harder to target ads. Finance chief Susan Li reminded analysts on Thursday that as 2024 progresses, the company will be lapping periods of increasingly strong demand. By late this year, analysts are projecting growth at Meta will be back down to the low teens at best. Growth estimates for Amazon and Alphabet are even lower, a good indication that calls for capital allocation measures may only get louder. Ben Berenger, technology analyst at Quilter Cheviot, told CNBC that Meta's decision to pay a dividend was a symbolic moment in that regard. Mark Zuckerberg is showing that he wants to bring shareholders along with him and is highlighting that Meta is now a mature, grown-up business, Berenger said. But what do you think? Please hit the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. And before we end, a word from the sponsor of this video. Today's sponsor is ProWorldNet.com. ProWorldNet.com is a job website specifically dedicated to licensed professions, doctors, including any type of specialty, nurses, and that includes all grades of nurses, lawyers, regardless of area of legal focus, teachers and professors, from kindergarten through graduate school, as well as any kind of job that requires a government license or certification. And ProWorldNet.com also includes short-term gig-type jobs as well. So, be sure to check out ProWorldNet.com if you are looking for a job or an employee. Thank you for watching.